The candles are forming. There is a notable correlation between gold and the prices of other precious metals such as silver and platinum. This correlation exists primarily because these metals often respond to similar economic and market factors, such as changes in the global economy, currency fluctuations, and investor sentiment towards safe haven assets. Gold and silver, in particular, exhibit a strong correlation due to their overlapping roles in the financial markets and their shared historical status as stores of value. Both metals are seen as hedges against inflation and currency devaluation. When economic uncertainty rises or when inflation expectations increase, investors tend to flock to gold and silver, driving up their prices. This synchronized movement is evident during financial crises or periods of geopolitical instability when both metals typically see a surge in demand. Platinum, while also a precious metal, has different industrial applications that affect its price correlation with gold and silver. Platinum is heavily used in the automotive industry for catalytic converters and in other industrial processes, making its price more sensitive to changes in industrial demand and economic cycles. However, despite these industrial influences, platinum does share some correlation with gold due to its status as a precious metal and a form of investment. During times of economic distress or when investors seek to diversify their portfolios, platinum can also experience price movements in tandem with gold. Another factor influencing the correlation between these metals is their response to changes in the U.S. dollar value. Precious metals are typically priced in dollars, so when the dollar weakens, the prices of gold, silver, and platinum tend to rise as they become cheaper for investors holding other currencies. Conversely, a strengthening dollar can exert downward pressure on these metals' prices. Moreover, market sentiment towards precious metals as a group can drive correlated movements. For example, when the overall sentiment is bullish on precious metals due to economic or geopolitical factors, investors might simultaneously increase their holdings in gold, silver, and platinum, leading to parallel price movements. In summary, while gold, silver, and platinum prices are correlated due to their shared characteristics as precious metals and their reactions to common economic and market factors, the degree of correlation can vary. Silver tends to have a stronger and more direct correlation with gold due to similar uses as investment assets. Platinum, though correlated, can sometimes deviate more due to its significant industrial demand. Understanding these correlations helps investors in diversifying their portfolios and making informed decisions based on market trends. Game is on. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. Our expert advisor is in action. Fundamental analysis is a method of evaluating financial markets, including Forex, by analyzing economic, social, and political factors that influence currency prices. This approach focuses on understanding the underlying factors driving currency value and predicting how these factors will affect future market movements. Fundamental analysis provides a comprehensive view of a currency's potential by examining various economic indicators, central bank policies, political stability, and market sentiment. One key component of fundamental analysis is the study of economic indicators. These include metrics such as gross domestic product, GDP, employment data, inflation rates, and interest rates. GDP measures the total economic output of a country, with strong GDP growth usually indicating a healthy economy and a potentially stronger currency. Employment data, including the unemployment rate and non-farm payrolls, can also signal economic health. Higher employment levels typically support a stronger currency. Inflation rates, measured by indicators like the Consumer Price Index, CPI, and Producer Price Index, PPI, impact currency value by affecting purchasing power. Moderate inflation is generally positive, but high inflation can weaken a currency. Interest rates, set by a country's central bank, are crucial as higher rates attract foreign investment, increasing demand for the currency. Central bank policies play a significant role in fundamental analysis. Central banks, such as the Federal Reserve, European Central Bank, and Bank of Japan, influence currency values through monetary policy. Actions like raising interest rates or reducing the money supply can strengthen a currency, while lowering interest rates or increasing the money supply can weaken it. Statements and meeting minutes from central banks provide insights into future monetary policy decisions, which influence market expectations and currency movements. Political stability and economic performance are also critical factors. Political events, such as elections, government policies, and geopolitical tensions, can significantly impact currency values. A stable political environment generally favors a currency, whereas instability can lead to depreciation. Economic performance indicators, such as trade balances, fiscal policies, and foreign direct investment, also affect currency strength. For instance, a trade surplus, where exports exceed imports, can boost a currency, while a trade deficit can weaken it. Market sentiment and news are integral to fundamental analysis. Market sentiment reflects the overall attitude of investors towards a particular currency and is influenced by news events, economic reports, and geopolitical developments. Positive sentiment can drive currency appreciation, while negative sentiment can lead to depreciation. Real-time news sources and economic calendars are essential tools for tracking events that can impact currency markets. The process of fundamental analysis involves several steps. First, traders gather and analyze economic data from reliable sources such as government reports, central bank releases, and financial news outlets. Understanding the context of this data is crucial, as it requires considering the broader economic environment and historical trends. For example, understanding how current inflation rates compare to historical averages can provide insights into potential future central bank actions. Using this information, traders forecast future currency movements, such as anticipating an appreciation if indicators suggest an upcoming interest rate hike. Finally, traders make informed trading decisions based on their analysis, often combining fundamental analysis with technical analysis to identify optimal entry and exit points. Fundamental analysis offers several advantages. It provides a comprehensive understanding of the factors driving currency value and helps anticipate long-term market trends based on economic fundamentals. This method is particularly useful for making informed decisions during significant economic events. However, fundamental analysis can be complex and time-consuming due to the vast amount of data to analyze. Market reactions to economic data can be unpredictable and influenced by short-term sentiment, and a deep understanding of global economics and geopolitical factors is required. In conclusion, fundamental analysis is a powerful tool for Forex traders, enabling them to make informed decisions based on economic and political factors that influence currency values. By staying informed about key economic indicators, central bank policies, and global events, traders can anticipate market movements and develop strategies to capitalize on them. Combining fundamental analysis with technical analysis can further enhance trading effectiveness, providing a well-rounded approach to navigating the Forex market. The gold market is going on. Successful Forex trading requires discipline, a solid strategy, and consistent habits. Developing these habits can enhance your trading skills and increase your chances of long-term success in the market. Continuous education. One of the best habits for a Forex trader is to continuously educate yourself. Stay updated with market news, economic reports, and geopolitical events that can affect currency movements. Regularly read books, attend webinars, and follow credible sources to improve your knowledge and skills. Continuous education ensures that you stay informed about the latest developments in the market and adapt your strategies accordingly. Developing and sticking to a trading plan. A well-defined trading plan is essential. Outline your trading goals, risk tolerance, and preferred trading strategies. Specify entry and exit points, risk management rules, and position sizing guidelines. Having a trading plan helps maintain discipline and consistency in your trading activities. It also prevents impulsive decisions based on emotions or market noise. Effective risk management. Implementing effective risk management techniques is crucial. Always use stop-loss orders to limit potential losses and never risk more than a small percentage of your trading capital on a single trade, typically 1 to 2%. This approach protects your capital and ensures that a few losing trades do not significantly impact your overall trading account. Proper risk management is the cornerstone of sustainable trading. Maintaining a trading journal. Keeping a trading journal is another valuable habit. Record all your trades, including the rationale behind each trade, entry and exit points, and outcomes. Regularly review your journal to identify patterns, strengths, and areas for improvement. A trading journal provides insights into your trading behavior and helps refine your strategies over time. Practicing patience and discipline. Patience and discipline are key traits of successful traders. Stick to your trading plan and avoid impulsive decisions driven by emotions. Wait for the right trading opportunities that align with your strategy. Patience ensures that you do not enter trades prematurely, and discipline helps you follow your plan without deviation. Staying updated with market conditions. Keep abreast of market conditions by monitoring economic indicators, central bank announcements, and political events that can influence the forex market. Use a reliable economic calendar to track important events. Staying informed about market conditions allows you to anticipate potential market movements and adjust your strategies accordingly. Diversifying your portfolio. Diversification is a fundamental risk management strategy. Avoid putting all your capital into a single currency pair. Instead, diversify your trades across different currency pairs and possibly other asset classes to spread risk. Diversification helps mitigate the impact of adverse movements in any single market. Utilizing technology and tools. Leverage technology and tools to enhance your trading. Use technical analysis tools, such as charts and indicators, to make informed trading decisions. Consider using automated trading systems or bots to execute trades based on predefined criteria. Technology can improve your trading efficiency and accuracy. Controlling emotions. Controlling your emotions is critical for consistent trading performance. Avoid letting fear, greed, or overconfidence dictate your trading decisions. Practice mindfulness or meditation to stay calm and focused. Emotional control helps maintain objectivity and prevents rash decisions that can lead to losses. Staying healthy. Maintaining a healthy lifestyle is often overlooked but essential for trading success. Regular exercise, a balanced diet, and adequate sleep contribute to mental and physical well-being. A healthy body and mind enhance your ability to make sound trading decisions and sustain long trading sessions. Regularly reviewing and adapting your strategy. Continuously evaluate the effectiveness of your trading plan and strategies. Be willing to adapt and make necessary adjustments based on your performance and changing market conditions. Regular review and adaptation ensure that your strategies remain relevant and effective. Networking with other traders. Engage with trading communities, forums, or groups to share insights, strategies, and experiences. Networking with other traders can provide valuable perspectives and improve your trading skills. Learning from others and discussing different approaches can enhance your understanding of the market. By developing and consistently practicing these habits, you can enhance your forex trading skills and increase your chances of long-term success in the market. Our expert advisor is active. Using bots in forex and gold trading offers several benefits, which can significantly enhance trading efficiency, accuracy, and overall profitability. These automated trading systems leverage advanced algorithms to execute trades based on predefined criteria, providing several advantages over manual trading. One of the primary benefits of using bots in trading is their ability to operate 24/7 without the limitations of human fatigue or emotions. Financial markets, especially Forex, operate continuously throughout the week, and bots can monitor and execute trades at any time, ensuring that no trading opportunities are missed due to human unavailability. This constant vigilance is particularly advantageous in highly volatile markets where prices can change rapidly. Bots also excel in executing trades with speed and precision. They can analyze vast amounts of data and respond to market movements in milliseconds, far faster than any human could. This speed is crucial in Forex and gold trading, where even slight delays can result in missed opportunities or suboptimal entry and exit points. By ensuring timely execution, bots can help traders capture favorable market conditions more effectively. Another significant benefit is the elimination of emotional biases from trading decisions. Human traders often fall prey to emotions such as fear, greed, and impatience, which can lead to irrational decisions and significant losses. Bots operate purely on logic and predefined strategies, maintaining discipline and consistency in their trading approach. This objective decision-making process can lead to more reliable and steady performance over time. Bots also provide the advantage of backtesting and optimization. Traders can test their strategies on historical data to assess their viability before deploying them in live markets. This backtesting capability allows for fine-tuning and optimizing trading algorithms to improve performance and reduce risks. By refining strategies based on historical performance, traders can increase their confidence in the bot's ability to handle various market conditions. Additionally, bots can manage multiple trading accounts and strategies simultaneously, offering scalability and diversification. This capability allows traders to spread their risk across different markets and strategies, enhancing their overall portfolio performance. Automated systems can also adjust their strategies dynamically based on changing market conditions, providing a level of adaptability that can be challenging to achieve manually. In conclusion, the use of bots in Forex and gold trading brings numerous benefits, including round-the-clock operation, rapid and precise trade execution, elimination of emotional biases, and the ability to backtest and optimize strategies. These advantages can lead to more disciplined, consistent, and potentially more profitable trading outcomes, making bots an invaluable tool for modern traders. Light discussion goes on. The daily trading volume in the Forex, foreign exchange, market is among the highest of any financial market in the world. On average, the Forex market sees a daily trading volume of over $6 trillion. This immense volume reflects the global nature of currency trading, involving a vast array of participants including banks, financial institutions, corporations, governments, and individual investors. The Forex market operates 24 hours a day, 5 days a week, across major financial centers like London, New York, Tokyo, and Sydney, contributing to its high liquidity and continuous activity. The major currency pairs, such as EUR, USD, USD, JPY, and GBP, USD, account for a significant portion of this daily volume. The high trading volume in these pairs is driven by their liquidity, tight spreads, and the substantial economic activities of the countries involved. Additionally, the Forex market's decentralized nature means that trading occurs over the counter, OTC, through a network of banks and brokers, facilitating extensive trading activity around the clock. In contrast, the daily trading volume of gold, while substantial, is significantly lower than that of the Forex market. On average, the gold market sees a daily trading volume of around $145 billion. This volume includes trading on various exchanges such as the London Bullion Market, the largest global center for over-the-counter gold trading, the COMEX in New York, the leading futures market for gold, and other regional exchanges. The gold market's trading volume is driven by various participants, including central banks, institutional investors, hedge funds, and retail investors. Gold is traded in several forms, including physical gold, bars and coins, futures contracts, options, and exchange-traded funds, ETFs. Each of these forms caters to different types of investors, from those seeking physical ownership to those looking to speculate on price movements or hedge against economic uncertainties. Gold trading is influenced by factors such as economic data releases, geopolitical events, and movements in other markets like currencies and equities. Its status as a safe haven asset means that demand can surge during periods of market turmoil or geopolitical instability, leading to higher trading volumes. Conversely, in more stable times, the volume may decrease as investors shift their focus to other assets. In summary, while the daily trading volume of gold is substantial at around $145 billion, it pales in comparison to the Forex market's staggering $6 trillion. The Forex market's vast volume reflects its global, decentralized, and highly liquid nature, whereas gold trading, despite being significant, is more specialized and influenced by specific economic and geopolitical factors. Both markets play crucial roles in the global financial system, offering unique opportunities for various types of investors. Gold is doing its work. Forex and gold trading offer various opportunities for traders, each with unique characteristics and potential benefits. In Forex trading, high liquidity is a major advantage. The Forex market is the largest financial market in the world, with a daily trading volume exceeding $6 trillion. This high liquidity ensures that traders can enter and exit positions easily. Additionally, the Forex market operates 24 hours a day, 5 days a week, providing flexibility for traders around the world to trade at their convenience. Leverage is another significant opportunity in Forex trading. Brokers often offer substantial leverage, allowing traders to control larger positions with a relatively small amount of capital. While this can amplify potential profits, it also increases the risk involved. The diversity of currency pairs available, including major, minor, and exotic pairs, allows traders to employ various strategies and capitalize on different economic conditions. Moreover, The Forex market is heavily influenced by economic data releases and geopolitical events, providing numerous opportunities for news-based trading. Gold trading also presents attractive opportunities. Gold is considered a safe haven asset, particularly during times of economic uncertainty or geopolitical tension. Investors often turn to gold to preserve value, creating opportunities during market downturns. Additionally, gold is commonly used as a hedge against inflation. When inflation rises, the value of currency can decrease, but gold often retains its value, making it an attractive asset in such scenarios. Including gold in a diversified investment portfolio can reduce overall risk. Its price movements are often inversely correlated with other asset classes, such as stocks and bonds. Gold can also experience significant price volatility, presenting opportunities for traders to capitalize on price swings through both short-term and long-term positions. Being a globally traded commodity, gold's price is influenced by international demand and supply dynamics, allowing traders to benefit from understanding global economic trends and geopolitical events. Various instruments are available for investing in gold, such as physical gold, gold futures, ETFs, and mining stocks, each offering different levels of risk and leverage. To succeed in both Forex and gold trading, effective risk management is crucial. This involves setting stop-loss orders and limiting leverage to mitigate potential losses. Continuous education and research about market trends, economic indicators, and trading strategies are vital. Staying informed about global events can aid in making better trading decisions. Utilizing a combination of technical analysis tools and fundamental analysis to understand market conditions and predict price movements can enhance trading outcomes. Patience and discipline are also essential. Sticking to a well-defined trading plan and avoiding emotional trading can lead to more consistent results. In summary, both Forex and gold trading offer numerous opportunities for traders who invest time in learning and developing their skills. The high liquidity, leverage, and market diversity in Forex, along with gold's status as a safe haven and hedge against inflation, provide various avenues for potential profit. However, it is crucial to approach both markets with a solid understanding of the associated risks and a well-thought-out trading strategy. The expert advisor is doing its work. Lot size is a fundamental concept in Forex and gold trading, significantly impacting a trader's risk management, potential profitability, and overall trading strategy. In Forex trading, a lot refers to the standardized quantity of a currency pair being traded, while in gold trading, it typically denotes the amount of gold, measured in ounces, being bought or sold. Understanding and selecting the appropriate lot size is crucial for effective trading. In Forex trading, lot sizes come in three main types: standard lots, 100,000 units of the base currency, mini lots, 10,000 units, and micro lots, 1,000 units. The chosen lot size determines the value of each pip movement in a trade. For example, in a standard lot, each pip is worth $10, in a mini lot, $1, and in a micro lot, 10 cents. Consequently, larger lot sizes can lead to higher profits from small price movements, but they also increase the potential for significant losses. Traders must therefore align their lot size with their risk tolerance and account balance to avoid overexposure. In gold trading, lot sizes are typically measured in ounces. For instance, one standard lot in gold trading often equals 100 ounces of gold. The value of each price movement, or tick, in gold can vary depending on the market and the broker, but it generally follows a similar principle to Forex trading. Larger lot sizes mean greater potential profits or losses. Given the volatility of gold prices, choosing an appropriate lot size is essential to manage risk effectively. Effective risk management in both Forex and gold trading is closely tied to the selection of lot sizes. Traders use lot sizes to control their exposure to the market. A larger lot size increases the leverage effect, which can amplify gains but also magnify losses. Therefore, prudent traders calculate their lot size based on their total capital, ensuring that no single trade can deplete a significant portion of their account. A common risk management rule is to risk only a small percentage, such as 1 to 2% of the trading account on any given trade, adjusting the lot size accordingly. Another important consideration is margin requirements, which are directly influenced by lot size. Larger lot sizes require more margin, or collateral, to open and maintain positions. This means that traders with smaller accounts need to be particularly cautious about over-leveraging, as this can quickly lead to margin calls or forced liquidation of positions. By selecting an appropriate lot size, traders can ensure they have sufficient margin to sustain their positions through market fluctuations. Lastly, the choice of lot size affects the psychological aspect of trading. Trading large lot sizes can induce stress and lead to emotional decision-making, especially for inexperienced traders. By starting with smaller lot sizes, traders can build confidence and experience without taking on excessive risk. Over time, as they develop a more robust trading strategy and a better understanding of market dynamics, they can gradually increase their lot sizes in a controlled manner. In summary, lot size is a critical factor in Forex and gold trading that affects risk management, profitability, margin requirements, and trader psychology. Selecting the appropriate lot size helps traders manage their exposure to market volatility, protect their capital, and maintain a disciplined approach to trading. Whether trading currencies or gold, understanding and carefully choosing lot sizes is essential for long-term trading success. Forex trading is not gambling at all. Fundamental analysis is a method of evaluating financial markets, including Forex, by analyzing economic, social, and political factors that influence currency prices. This approach focuses on understanding the underlying factors driving currency value and predicting how these factors will affect future market movements. Fundamental analysis provides a comprehensive view of a currency's potential by examining various economic indicators, central bank policies, political stability, and market sentiment. One key component of fundamental analysis is the study of economic indicators. These include metrics such as gross domestic product, GDP, employment data, inflation rates, and interest rates. GDP measures the total economic output of a country, with strong GDP growth usually indicating a healthy economy and a potentially stronger currency. Employment data, including the unemployment rate and non-farm payrolls, can also signal economic health. Higher employment levels typically support a stronger currency. Inflation rates, measured by indicators like the Consumer Price Index, CPI, and Producer Price Index, PPI, impact currency value by affecting purchasing power. Moderate inflation is generally positive, but high inflation can weaken a currency. Interest rates, set by a country's central bank, are crucial as higher rates attract foreign investment, increasing demand for the currency. Central bank policies play a significant role in fundamental analysis. Central banks, such as the Federal Reserve, European Central Bank, and Bank of Japan, influence currency values through monetary policy. Actions like raising interest rates or reducing the money supply can strengthen a currency, while lowering interest rates or increasing the money supply can weaken it. Statements and meeting minutes from central banks provide insights into future monetary policy decisions, which influence market expectations and currency movements. Political stability and economic performance are also critical factors. Political events, such as elections, government policies, and geopolitical tensions, can significantly impact currency values. A stable political environment generally favors a currency, whereas instability can lead to depreciation. Economic performance indicators, such as trade balances, fiscal policies, and foreign direct investment, also affect currency strength. For instance, a trade surplus, where exports exceed imports, can boost a currency, while a trade deficit can weaken it. Market sentiment and news are integral to fundamental analysis. Market sentiment reflects the overall attitude of investors towards a particular currency and is influenced by news events, economic reports, and geopolitical developments. Positive sentiment can drive currency appreciation, while negative sentiment can lead to depreciation. Real-time news sources and economic calendars are essential tools for tracking events that can impact currency markets. The process of fundamental analysis involves several steps. First, traders gather and analyze economic data from reliable sources such as government reports, central bank releases, and financial news outlets. Understanding the context of this data is crucial, as it requires considering the broader economic environment and historical trends. For example, understanding how current inflation rates compare to historical averages can provide insights into potential future central bank actions. Using this information, traders forecast future currency movements, such as anticipating an appreciation if indicators suggest an upcoming interest rate hike. Finally, traders make informed trading decisions based on their analysis, often combining fundamental analysis with technical analysis to identify optimal entry and exit points. Fundamental analysis offers several advantages. It provides a comprehensive understanding of the factors driving currency value and helps anticipate long-term market trends based on economic fundamentals. This method is particularly useful for making informed decisions during significant economic events. However, fundamental analysis can be complex and time-consuming due to the vast amount of data to analyze. Market reactions to economic data can be unpredictable and influenced by short-term sentiment, and a deep understanding of global economics and geopolitical factors is required. In conclusion, fundamental analysis is a powerful tool for forex traders, enabling them to make informed decisions based on economic and political factors that influence currency values. By staying informed about key economic indicators, central bank policies, and global events, traders can anticipate market movements and develop strategies to capitalize on them. Combining fundamental analysis with technical analysis can further enhance trading effectiveness, providing a well-rounded approach to navigating the forex market. Always take calculated risk. In the realm of Forex and gold trading, brokers play a crucial role by providing platforms and services that enable traders to buy and sell currencies and precious metals. There are several types of brokers catering to different trading needs and preferences. Understanding these types can help traders choose the broker that best aligns with their trading strategies and objectives. The first type of broker is the market maker. Market makers create a market for traders by setting bid and ask prices and standing ready to buy or sell at those prices. They essentially act as counterparties to traders' transactions, which means that they can provide liquidity even when there are no immediate buyers or sellers in the market. Market makers often offer fixed spreads, which can be beneficial for traders looking for price certainty. However, since they are the counterparty to trades, there can be potential conflicts of interest, as the broker may benefit from traders' losses. Another type of broker is the Electronic Communication Network, ECN, broker. ECN brokers connect traders directly with other participants in the market, such as banks, financial institutions, and other traders. This means that traders can get access to the best bid and ask prices available in the market, which often results in tighter spreads. ECN brokers typically charge a commission on trades instead of widening the spread. This type of broker is ideal for traders who prefer transparency and direct market access, particularly those who employ high-frequency or scalping strategies. Straight-through processing, STP, brokers are similar to ECN brokers in that they route traders' orders directly to liquidity providers. However, STP brokers do not necessarily match orders with other traders but rather send them to their pool of liquidity providers, which can include banks and other brokers. STP brokers may offer variable spreads depending on the liquidity available from their providers. This type of broker provides a more seamless trading experience and can be a good choice for traders who value direct access to market liquidity without the potential conflicts of interest seen with market makers. For traders focusing on gold trading, some brokers specialize as commodity brokers. These brokers provide platforms that facilitate trading in various commodities, including gold. They offer access to gold futures, options, and spot markets. Commodity brokers often provide specialized tools and research that cater specifically to commodity traders. They are suitable for those who require detailed market analysis and hedging options in the commodities space. Finally, multi-asset brokers offer a wide range of trading instruments, including Forex, gold, stocks, indices, and other commodities. These brokers cater to traders looking for diversification across different asset classes from a single platform. Multi-asset brokers typically offer comprehensive trading tools and resources, making them suitable for traders who want to manage a diverse portfolio. In summary, the choice of a Forex and gold trading broker depends on the trader's specific needs and trading style. Market makers provide liquidity and fixed spreads, while ECN and STP brokers offer direct market access with potentially tighter spreads. Commodity brokers specialize in the gold market, and multi-asset brokers provide a wide range of trading instruments. Understanding the differences between these brokers can help traders select the right partner for their trading endeavors. The market is active. The correlation between gold and the forex market is a nuanced relationship influenced by various economic, geopolitical, and market factors. Understanding this correlation can offer valuable insights for traders and investors aiming to optimize their strategies. Firstly, gold is often considered a safe haven asset, meaning it tends to appreciate during times of economic uncertainty or geopolitical instability. This inverse relationship is particularly evident with major currencies like the US dollar, USD. When confidence in the global economy wanes, investors flock to gold as a store of value, leading to its price increase. Consequently, the demand for the USD may decline as investors seek safety in gold, causing the dollar to depreciate. This inverse correlation can be observed during financial crises, political turmoil, or periods of high inflation, where gold prices surge while the USD weakens. Secondly, gold and certain currencies share a more direct correlation due to their economic ties. For instance, currencies of countries that are major gold producers, such as the Australian dollar, AUD, and the South African rand, ZAR, often move in tandem with gold prices. When gold prices rise, these countries' export revenues increase, strengthening their currencies. Conversely, a drop in gold prices can weaken their currencies. Traders often monitor gold prices to predict movements in these currencies, leveraging this correlation to make informed trading decisions. The relationship between gold and forex markets is also influenced by central bank policies. Central banks hold gold reserves and engage in monetary policies that can impact both gold prices and currency values. For example, during periods of quantitative easing, QE, or low interest rates, the value of fiat currencies may decline, making gold more attractive as an inflation hedge. As a result, gold prices rise while currencies depreciate. Conversely, when central banks tighten monetary policy or raise interest rates, fiat currencies tend to strengthen, and gold prices may fall. Traders keep a close eye on central bank announcements and policies to anticipate these shifts in the market. Moreover, the correlation between gold and the forex market is shaped by inflation expectations. Gold is traditionally seen as a hedge against inflation, retaining its value when the purchasing power of currencies declines. When inflation expectations rise, demand for gold typically increases, driving up its price. This increased demand can result in the depreciation of currencies, particularly those most affected by inflation. Forex traders use inflation indicators and economic reports to gauge potential impacts on currency values and gold prices, adjusting their positions accordingly. Lastly, the broader macroeconomic environment plays a critical role in the gold-forex correlation. Factors such as global trade dynamics, commodity prices, and investor sentiment all contribute to the interplay between gold and currency markets. For example, in times of economic expansion, higher industrial demand for commodities can drive up gold prices, while strong economic performance can bolster certain currencies. Conversely, during economic downturns, the flight to safety can lead to a stronger gold market and weaker currencies. In summary, the correlation between gold and the forex market is multifaceted, driven by safe haven dynamics, economic ties of gold-producing countries, central bank policies, inflation expectations, and broader macroeconomic conditions. Understanding these relationships enables traders and investors to make more informed decisions, leveraging the interplay between gold and currency markets to optimize their trading strategies. Our expert advisor is analyzing candles formed by the market. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. The Bank of England, BOE, has a long and significant relationship with gold, playing a pivotal role in the global gold market. Established in 1694, the BOE has historically been one of the key institutions in managing gold reserves, both for the United Kingdom and other countries. Its gold vaults are among the largest and most secure in the world, housing not only the UK's gold reserves but also substantial holdings for various other central banks and international organizations. The BOE's role in gold began to solidify in the 19th century with the establishment of the gold standard. Under the gold standard, the value of the British pound was directly linked to a specific quantity of gold, and the BOE was responsible for maintaining this parity. This system provided a stable currency exchange environment, which facilitated international trade and economic stability. Although the gold standard was eventually abandoned in the early 20th century, the BOE continued to manage significant gold reserves. Today, the Bank of England remains a key player in the global gold market primarily through its custodial services. The BOE offers secure storage facilities for gold bars in its underground vaults, which are renowned for their security. These vaults are located deep below the streets of London and contain hundreds of thousands of gold bars, making it one of the largest repositories of gold in the world. The BOE provides custodial services not only for the UK but also for numerous foreign central banks and international financial institutions, ensuring the safety and integrity of their gold holdings. In addition to storage, the BOE facilitates the trading of gold. It acts as an intermediary for gold transactions, leveraging its reputation and infrastructure to ensure that trades are executed smoothly and securely. This role is crucial in maintaining the liquidity and efficiency of the gold market. The bank also plays a part in the London bullion market, one of the world's major gold trading centers, by helping to set standards and practices that govern the trading and settlement of gold. The BOE's gold reserves serve as an important financial buffer and a means of diversifying the national reserves. Gold is seen as a hedge against inflation and currency devaluation, providing financial stability in times of economic uncertainty. The BOE periodically reviews its gold holdings as part of its broader strategy to manage the UK's foreign exchange and reserve assets. Furthermore, the Bank of England's involvement in the gold market extends to policy influence. Through its actions and communications, the BOE can impact gold prices and market perceptions. For instance, Decisions on interest rates and monetary policy, while primarily aimed at controlling inflation and supporting economic growth, can indirectly affect gold prices. A lower interest rate environment, often associated with a weaker currency, can lead to higher gold prices as investors seek safe haven assets. In summary, the Bank of England plays a multifaceted role in the global gold market, from serving as a secure custodian and facilitator of gold trading to influencing market conditions through its monetary policies. Its historical and ongoing involvement underscores the importance of gold in global finance and the trust placed in the bow by countries and institutions worldwide. Light discussion on various aspects of trading, from risk management to mindset and strategy, that are of great value to everyone, especially new traders. The Bank of Japan, BOJ, Japan's central bank, has a nuanced relationship with gold, playing a significant role in managing the country's gold reserves and influencing the broader gold market through its monetary policies. The BOJ, established in 1882, has traditionally focused on maintaining financial stability, implementing monetary policy, and ensuring the smooth functioning of payment and settlement systems in Japan. Historically, the BOJ's involvement with gold was prominent during periods when gold played a central role in the global monetary system. Like many other countries, Japan was on the gold standard in the early 20th century, which required the BOJ to maintain substantial gold reserves to back its currency. This system linked the value of the Japanese yen directly to a specific amount of gold, providing a measure of monetary stability and facilitating international trade. Although the gold standard was abandoned globally during the 20th century, the BOJ continues to hold gold as part of its foreign exchange reserves. Gold is considered a strategic asset by the BOJ, providing a hedge against inflation, currency devaluation, and financial instability. While the exact amount of gold held by the BOJ is subject to periodic disclosure, it forms a relatively small but important part of Japan's overall reserves, which are primarily composed of foreign currencies like the US dollar. The BOJ's monetary policies can indirectly impact the gold market. Japan has experienced prolonged periods of economic stagnation and deflation, leading the BOJ to adopt unconventional monetary policies such as quantitative easing, QE, and negative interest rates. These policies, aimed at stimulating economic growth and combating deflation, tend to weaken the yen and lower interest rates. In turn, a weaker yen and lower interest rates can make gold more attractive to investors as a non-yielding asset, thereby influencing global gold prices. Moreover, the BOJ's approach to monetary policy often serves as a benchmark for other central banks. When the BOJ implements significant policy changes, such as large-scale asset purchases or interest rate adjustments, it can set precedents that affect global market sentiment, including the demand for gold. Investors closely monitor the BOJ's actions and statements for indications of future policy directions, which can create ripple effects in the gold market. In terms of operational involvement, the BOJ does not engage in gold trading in the same way that some other central banks do. Instead, it focuses on the secure storage and prudent management of its gold reserves. The BOJ ensures that its gold holdings are safe and can be liquidated if necessary to stabilize the economy or the financial system. Additionally, Japan's gold market is supported by a robust infrastructure, including the Tokyo Commodity Exchange, TOCOM, where gold futures are traded. While the BOJ itself does not directly participate in these markets, its policies and the overall economic environment it helps shape have a significant impact on gold trading activity in Japan. The BOJ's influence on interest rates, inflation expectations, and currency values can drive investor behavior in the gold market. In summary, the Bank of Japan's relationship with gold is multifaceted, encompassing the management of gold reserves, influencing gold prices through monetary policy, and impacting investor sentiment in the gold market. While the BOJ's direct involvement with gold may be less pronounced compared to some other central banks, its economic policies and strategic reserve management play a critical role in shaping the broader financial landscape in which gold operates. Gold is moving. Using bots in Forex and gold trading offers several benefits, which can significantly enhance trading efficiency, accuracy, and overall profitability. These automated trading systems leverage advanced algorithms to execute trades based on predefined criteria, providing several advantages over manual trading. One of the primary benefits of using bots in trading is their ability to operate 24/7 without the limitations of human fatigue or emotions. Financial markets, especially Forex, operate continuously throughout the week, and bots can monitor and execute trades at any time, ensuring that no trading opportunities are missed due to human unavailability. This constant vigilance is particularly advantageous in highly volatile markets where prices can change rapidly. Bots also excel in executing trades with speed and precision. They can analyze vast amounts of data and respond to market movements in milliseconds, far faster than any human could. This speed is crucial in Forex and gold trading, where even slight delays can result in missed opportunities or suboptimal entry and exit points. By ensuring timely execution, bots can help traders capture favorable market conditions more effectively. Another significant benefit is the elimination of emotional biases from trading decisions. Human traders often fall prey to emotions such as fear, greed, and impatience, which can lead to irrational decisions and significant losses. Bots operate purely on logic and predefined strategies, maintaining discipline and consistency in their trading approach. This objective decision-making process can lead to more reliable and steady performance over time. Bots also provide the advantage of backtesting and optimization. Traders can test their strategies on historical data to assess their viability before deploying them in live markets. This backtesting capability allows for fine-tuning and optimizing trading algorithms to improve performance and reduce risks. By refining strategies based on historical performance, traders can increase their confidence in the bot's ability to handle various market conditions. Additionally, bots can manage multiple trading accounts and strategies simultaneously, offering scalability and diversification. This capability allows traders to spread their risk across different markets and strategies, enhancing their overall portfolio performance. Automated systems can also adjust their strategies dynamically based on changing market conditions, providing a level of adaptability that can be challenging to achieve manually. In conclusion, The use of bots in forex and gold trading brings numerous benefits, including round-the-clock operation, rapid and precise trade execution, elimination of emotional biases, and the ability to backtest and optimize strategies. These advantages can lead to more disciplined, consistent, and potentially more profitable trading outcomes, making bots an invaluable tool for modern traders. The expert advisor is working. Choosing between manual and automated forex trading depends on various factors, including your trading style, experience level, and personal preferences. Here's a detailed comparison to help you understand the differences and make an informed decision. Manual forex trading. Manual trading offers significant control and flexibility. Traders have full control over each trade, allowing for adjustments based on real-time market conditions. This flexibility enables traders to incorporate new information and adapt to changing market scenarios swiftly. Moreover, manual trading enhances your trading skills and understanding of the market through direct experience, providing the opportunity to develop and refine your strategies and techniques. However, manual trading is time-consuming, requiring constant monitoring of the markets, which can be very demanding, especially during high volatility periods. Emotional influences are a major drawback, as traders can fall victim to biases like fear, greed, or overconfidence, negatively impacting trading decisions. Maintaining consistent execution can also be challenging, particularly when dealing with multiple trades or complex strategies. Automated Forex trading. Automated trading, on the other hand, offers efficiency and speed. Automated systems execute trades at lightning speed, capitalizing on even the smallest market movements and handling multiple trades simultaneously without human error. This method eliminates emotional influences, ensuring consistency and discipline by adhering strictly to predefined strategies and rules. Additionally, automated trading saves time, requiring less active monitoring and allowing traders to focus on strategy development and other activities. It also enables backtesting and optimization of strategies on historical data, helping evaluate performance and fine-tune parameters. Despite these advantages, automated trading lacks flexibility, as it cannot adapt to unexpected market conditions or news events not accounted for in the algorithm. The rigid adherence to predefined rules may result in missed opportunities or increased losses. Technical issues, such as software bugs, connectivity problems, or server outages, pose another risk, requiring regular maintenance and updates to ensure optimal performance. There's also the risk of over-optimizing the trading strategy to past data, which may not perform well in live markets, known as curve fitting. Lastly, setting up a reliable automated system demands a significant initial investment in terms of time and money, along with ongoing costs for software updates, data feeds, and possibly VPS hosting. Choosing the right approach. Consider manual trading if you prefer having full control over your trades, enjoy analyzing market data and making discretionary decisions, are willing to invest the time required to monitor and manage trades actively, and value the learning experience and skill development from direct market interaction. Opt for automated trading if you have a well-defined, tested trading strategy that can be coded into an algorithm, want to eliminate emotional biases and maintain consistent execution, have limited time to spend on active trading but still want to participate in the market, and are comfortable with the technical aspects of setting up and maintaining automated systems. Ultimately, some traders use a combination of both methods, leveraging the strengths of each to optimize their trading performance. For instance, they might use automated systems for certain strategies or market conditions while manually trading others. The market is in motion. Before elaborating my trading strategy, I would like to advise new traders that their first target, as a forex trader, should be to save your capital. Once you have mastered saving your capital, then go for earning from forex trading. And after getting the skill of earning, you should try to become rich or millionaire by forex trading. But if you directly want to achieve third level, you can never be profitable. The forex market is very uncertain. There is no strategy that is always 100% profitable. Risk management, proper psychology and control of emotions are the factors behind my strategy. I may be in loss, in a session or in a day, but not in a week or a month. That's how things work in the life of a forex trader, and that's the beauty of forex trading. The key points of my trading strategy are: I do semi-automated trading. It's very difficult for a human to control his psychology and emotions during trading in highly volatile market of forex. That's why I believe software tools are necessary in forex trading. I use hybrid approach in my trading that involves human input as well as my own developed expert advisor, EA, algorithm to hint for best entries in trendy and sideways market, keeping in view the running fundamentals of the market. My EA doesn't follow the direction of any daily technical analysis, but looks for suitable entries in both directions, sell and buy. The TP, SL and break-even settings are performed by the EA bot. That really makes my work easy. I constantly keep on improving my EA to improve its performance. I trade all sessions. No doubt, there is more trading volume in the market during New York session and during sessions overlapping. However, good opportunities can come anytime. That's why I love to trade all sessions, looking for nice entries. I take multiple positions in same direction. Whenever I found a suitable entry, I run multiple positions of same lot size and same stop loss, but with different take profits. One of these positions will have open TP, in order to take maximum benefit from big market moves. Sometimes my SLs may trigger in a row, but these net SLs are much smaller than my net TPs. That's what makes me profitable. I do break-even of remaining positions after 1 or 2 TP hits. In my trading, when 1 or 2 TPs are hit, I move SLs of all other running positions to break-even level. This may deprive me of taking benefit from my entry, if market retests my entry level and then bounces back in my direction. In this case, I don't take next entry in same direction. I'll wait, and the waiting period sometimes may extend even up to a couple of hours or so, until I found an opportunity in opposite direction. Then I will take my next entry. Low risk and high reward trading makes you a profitable trader. Backtesting trading strategies is a crucial step in the development and refinement of any trading system. It involves applying a trading strategy to historical market data to evaluate its performance over time. By simulating trades that would have occurred in the past, traders can gain insights into the potential effectiveness and profitability of their strategies without risking real capital. The process of backtesting starts with the selection of a trading strategy. This strategy includes specific rules for entering and exiting trades, position sizing, and risk management. Once the strategy is defined, it is applied to historical data to simulate how it would have performed under actual market conditions. This helps traders identify whether the strategy can generate consistent returns and withstand various market scenarios. One of the primary benefits of backtesting is that it allows traders to validate their strategies before committing real money. By testing a strategy on past data, traders can identify potential flaws and make necessary adjustments. This process helps in refining the strategy to enhance its performance and robustness. Additionally, backtesting provides statistical measures such as win rate, average profit, loss, maximum drawdown, and Sharpe ratio, which are essential for evaluating the risk and return profile of the strategy. Backtesting also helps traders understand the historical context and behavior of their strategies. For example, a strategy that performs well in a trending market may not fare as well in a sideways or choppy market. By analyzing historical performance, traders can identify the market conditions under which their strategies perform best and make informed decisions about when to deploy them. This contextual understanding is crucial for adapting strategies to changing market environments. Moreover, backtesting facilitates the optimization of trading strategies. Traders can test various parameters and settings to find the optimal combination that maximizes returns and minimizes risks. For instance, they can adjust the time frames, technical indicators, or stop-loss levels to see how these changes impact the strategy's performance. Optimization helps in fine-tuning the strategy to achieve better results, but it must be done carefully to avoid overfitting, where a strategy performs well on historical data but fails in live markets due to excessive customization. Lastly, backtesting builds confidence in a trading strategy. When traders see consistent and favorable results from backtesting, they are more likely to trust and stick to their strategies during live trading. This confidence is crucial for maintaining discipline, especially during periods of drawdown or market volatility. It reassures traders that their strategies have been rigorously tested and are likely to yield positive outcomes over the long term. In summary, backtesting trading strategies is an essential practice that helps traders validate, refine, and optimize their strategies using historical data. It provides valuable insights into the strategy's performance, helps identify optimal settings, and builds confidence in its application. By thoroughly backtesting their strategies, traders can enhance their chances of success in the dynamic and unpredictable world of trading. Gold is forming its candles. Forex, gold and crypto trading can be facilitated through either traditional brokers or proprietary trading firms, prop firms, each offering distinct advantages and disadvantages depending on a trader's goals, experience, and resources. Understanding the differences between these two options can help traders make informed decisions about where to direct their trading efforts. Brokers provide individual traders with the platform and resources to trade in the market. Brokers typically offer a range of trading accounts, from standard to ECN, electronic communication network, accounts, catering to both retail and professional traders. They provide access to various trading tools, educational resources, and customer support, which can be particularly beneficial for novice traders. Brokers earn through spreads, the difference between bid and ask prices, or commissions on trades. This model allows traders to maintain control over their capital, strategies, and risk management. However, trading with brokers requires personal capital, and the potential for loss is directly borne by the trader. In contrast, proprietary trading firms, prop firms, operate differently by allowing traders to trade the firm's capital rather than their own. This setup significantly reduces the financial risk for traders while providing the opportunity to earn a share of the profits. Prop firms usually require traders to pass a rigorous evaluation process to demonstrate their trading skills and discipline. Successful candidates gain access to the firm's capital and resources, such as advanced trading platforms, professional development programs, and mentorship. This model is particularly attractive to skilled traders who lack sufficient personal capital but possess the expertise to generate consistent returns. One of the main advantages of trading with a prop firm is the leverage provided by the firm's capital. Traders can take larger positions than they could with their funds, potentially leading to higher profits. Additionally, prop firms often cover the operational costs, including trading platforms and data feeds, which can otherwise be significant for individual traders. The support and structured environment of a prop firm can also enhance a trader's performance and discipline, thanks to the access to seasoned professionals and a collaborative trading environment. However, trading with prop firms comes with its own set of challenges. The evaluation process to join a prop firm can be stringent, with a focus on risk management and consistency rather than just profitability. Traders may face pressure to meet performance targets and adhere to the firm's risk management policies, which can limit trading flexibility. Furthermore, profit splits between the trader and the firm mean that traders do not retain the full earnings of their successful trades, unlike in personal accounts with brokers. In summary, choosing between a broker and a prop firm depends largely on a trader's individual circumstances and goals. Brokers offer autonomy and full control over trading strategies and profits but require personal capital and bear the full risk of losses. Prop firms, on the other hand, provide the opportunity to trade with substantial capital and professional support, reducing personal financial risk but often at the cost of profit sharing and adherence to strict performance criteria. Traders must weigh these factors to determine which option best suits their trading style and financial objectives. Our expert advisor is reading candles. Trading hammer and inverted hammer candles involves understanding their formation, context within the market, and confirmation signals. These candlestick patterns are indicative of potential reversals and can be powerful tools for traders when used correctly. A hammer candle is characterized by a small body at the upper end of the trading range and a long lower wick. This formation typically occurs at the bottom of a downtrend and signifies a potential bullish reversal. The long lower wick indicates that sellers drove the price down significantly during the session, but strong buying pressure brought the price back up near the opening level. This buying interest suggests that the downtrend may be losing momentum and buyers are starting to take control. To trade a hammer candle, look for confirmation of the reversal signal. This confirmation often comes in the form of a subsequent bullish candle that closes higher than the hammer's close. Entering a long position after the confirmation candle helps reduce the risk of false signals. It's also advisable to place a stop-loss order below the hammer's lower wick to protect against further downside. Additionally, analyzing volume can provide further validation. A hammer candle with high trading volume indicates stronger conviction in the reversal. An inverted hammer candle, conversely, has a small body at the lower end of the trading range and a long upper wick. This pattern usually appears after a downtrend and suggests a potential bullish reversal. The long upper wick demonstrates that buyers pushed prices higher during the session, but sellers managed to bring it back down. Nonetheless, the buying interest signals that the downtrend might be weakening. Trading an inverted hammer involves similar steps to trading a hammer candle. Wait for a confirmation candle that closes higher than the inverted hammer's close to validate the potential reversal. Enter a long position after the confirmation and place a stop-loss below the inverted hammer's low to limit risk. Volume analysis can again be useful. A significant volume on the inverted hammer day can indicate a more reliable reversal signal. Both hammer and inverted hammer candles are most effective when they appear at key support levels or within a broader technical context, such as at the end of a retracement in an uptrend. Combining candlestick analysis with other technical tools like moving averages, trend lines, or Fibonacci retracement levels can enhance the accuracy of these patterns. Patience and discipline in waiting for confirmation and managing risk are crucial for successfully trading hammer and inverted hammer candles. The key to trading success is emotional discipline. Leverage is a powerful tool in forex and gold trading that allows traders to control large positions with a relatively small amount of capital. By using leverage, traders can amplify their potential profits, but it also comes with the increased risk of significant losses. Understanding how leverage works and managing its use effectively is crucial for successful trading. In essence, leverage is the ratio of a trader's own capital to the borrowed capital used for trading. It is commonly expressed in ratios such as 50 to 1, 100 to 1, or even 500 to 1. For example, with a leverage ratio of 100 to 1, a trader can control a $100,000 position with just $1,000 of their own funds. This capability allows traders to participate in larger trades than they could with their own capital alone, potentially leading to greater profits from small market movements. Leverage significantly magnifies both potential gains and potential losses. While a small price movement in the desired direction can result in substantial profits, an adverse movement can quickly deplete a trader's capital. This dual-edged nature of leverage makes risk management paramount. Traders must carefully consider their leverage ratio and ensure they do not overextend themselves. Using too high a leverage ratio can lead to margin calls, where the broker requires additional funds to cover potential losses, or even the forced closure of positions to prevent further losses. Margin is closely linked to leverage and refers to the amount of money required to open and maintain a leveraged position. Brokers set margin requirements based on the leverage ratio, meaning that higher leverage requires a lower margin. For instance, with 100 to 1 leverage, the margin requirement would be 1% of the total position size. While this enables traders to use less of their own capital, it also means that their account is more susceptible to rapid changes in equity due to market fluctuations. Effective use of leverage requires a disciplined approach to risk management. Traders should use stop-loss orders to limit potential losses and protect their capital. Setting appropriate stop-loss levels helps to ensure that a position is closed before losses exceed a predefined threshold. Additionally, traders should carefully consider their position size relative to their account balance and avoid using the maximum available leverage. By using lower leverage, traders can reduce the risk of significant losses and better manage their overall risk exposure. Furthermore, understanding market conditions and volatility is crucial when using leverage. Markets with higher volatility can lead to larger price swings, which can quickly affect leveraged positions. Traders need to be aware of economic events, news releases, and other factors that can increase market volatility. By staying informed and adjusting their leverage and positions accordingly, traders can navigate the risks associated with leveraging in volatile markets. In summary, leverage is a potent tool in forex and gold trading that allows traders to control large positions with relatively small amounts of capital. While it can amplify profits, it also increases the potential for significant losses. Effective leverage use requires a thorough understanding of risk management, margin requirements, and market conditions. By using leverage judiciously and employing strict risk management practices, traders can harness its benefits while mitigating its inherent risks. Gold is in move. The London and New York trading sessions are two of the most significant periods in the Forex market, each with unique characteristics that influence trading strategies and market behavior. Understanding the differences between these sessions can help traders optimize their activities and capitalize on the distinct opportunities each session presents. The London session, which runs from 8 a.m. to 4 p.m. Greenwich Mean Time, is the most active Forex trading period. London has historically been a major financial hub, and this session sees a high volume of transactions and liquidity. The London session overlaps with the Asian and New York sessions, making it a critical time for trading. During this period, traders can expect high volatility and significant price movements, especially in currency pairs involving the British pound, GBP, the euro, EUR, and the Swiss franc, CHF. Economic data releases from the UK and the Eurozone often impact market activity, and traders need to stay informed about these announcements to anticipate potential market shifts. Key features of the London session include its liquidity and the variety of trading opportunities available. The high trading volume means that orders are executed quickly and with minimal slippage. This liquidity also allows for tighter spreads, reducing trading costs. Additionally, many of the world's largest banks and financial institutions are active during this session, contributing to the deep liquidity and dynamic market movements. Traders can take advantage of the heightened volatility by employing strategies such as trend trading or breakout trading, which rely on significant price movements. In contrast, the New York session runs from 8 a.m. to 5 p.m. Eastern Standard Time. It begins as the London session is winding down, creating a period of overlap from 8 a.m. to 12 p.m. Eastern Standard Time, which is one of the most active times in the Forex market. The New York session is influenced heavily by economic data releases from the United States, including reports on employment, GDP, and consumer sentiment. These releases can cause sharp market movements, particularly in USD currency pairs. The New York session is also known for its volatility, but it tends to be driven by different factors compared to the London session. The focus shifts more towards U.S. economic news and developments, which can create significant trading opportunities. Major U.S. financial institutions and hedge funds are highly active during this time, contributing to large trade volumes and liquidity. The New York session's impact on market sentiment can be profound, often setting the tone for the rest of the trading day. One key aspect of the New York session is the afternoon lull, that can occur after the London market closes. This period may see reduced volatility and lower trading volumes as European traders exit the market, leading to quieter market conditions. However, this can also be an opportunity for traders to reassess positions and plan for potential movements when the Asian markets open. In summary, the London and New York trading sessions are pivotal periods in the Forex market, each with its own dynamics and opportunities. The London session is characterized by high liquidity, volatility, and significant price movements influenced by European economic data. The New York session, while also volatile, is heavily driven by U.S. economic releases and can set the stage for market trends. Traders should tailor their strategies to the unique conditions of each session, leveraging the periods of high activity and adjusting to the shifts in market behavior as the sessions overlap and transition. The expert advisor is on its work. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. The risk-reward ratio is a fundamental concept in trading that helps traders assess the potential profitability of a trade relative to its potential loss. It is calculated by dividing the potential profit, reward, of a trade by the potential loss, risk. The best risk-reward ratio depends on a trader's strategy, risk tolerance, and market conditions, but understanding and applying this concept is crucial for long-term trading success. A commonly recommended risk-reward ratio is 1 to 2, meaning that for every dollar risked, the potential reward should be $2. This ratio ensures that even if a trader only wins 50% of their trades, they can still be profitable. For instance, if a trader risks $100 on a trade with the potential to make $200, they need to win only half of their trades to break even or be profitable. This approach encourages disciplined trading and helps traders maintain a positive expectancy over time. However, the optimal risk-reward ratio can vary based on the trader's style and strategy. Scalpers, who execute numerous trades within a short period, might work with lower risk-reward ratios, such as 1 to 1 or 1 to 1.5, due to the high frequency of trades and smaller profit targets. On the other hand, swing traders and position traders, who hold trades for longer periods, might aim for higher risk-reward ratios like 1 to 3 or 1 to 4, capitalizing on larger price movements and trends. The selection of the best risk-reward ratio also depends on the accuracy or win rate of the trading strategy. A strategy with a high win rate can afford a lower risk-reward ratio because the frequent small profits can outweigh occasional losses. Conversely, a strategy with a lower win rate requires a higher risk-reward ratio to remain profitable. For example, a strategy with a win rate of 40% might need a risk-reward ratio of 1 to 3 to ensure that the wins cover the losses and provide overall profitability. Implementing a favorable risk-reward ratio requires careful planning and discipline. Traders should establish clear entry and exit points for each trade, setting stop-loss and take-profit orders to manage risk and reward effectively. By determining these levels in advance, traders can avoid emotional decision-making and adhere to their trading plan. Additionally, consistently applying a predetermined risk-reward ratio helps traders evaluate and refine their strategies over time. It is also essential to consider market conditions when determining the best risk-reward ratio. Volatile markets may offer more significant profit opportunities but also carry higher risks, potentially justifying higher risk-reward ratios. In contrast, stable markets might require more conservative ratios due to limited price fluctuations. Traders should adapt their risk-reward approach to the current market environment to optimize their chances of success. In summary, the best risk-reward ratio in trading is subjective and varies based on the trader's style, strategy, risk tolerance, and market conditions. While a 1 to 2 ratio is a common starting point, traders must tailor their risk-reward ratios to fit their specific trading approach and objectives. By consistently applying a suitable risk-reward ratio, traders can enhance their profitability and ensure a disciplined, strategic approach to the markets. The expert advisor is analyzing the current dynamics of the market. Successful trading requires discipline, a solid strategy, and consistent habits. Developing these habits can enhance your trading skills and increase your chances of long-term success in the market. Continuous education. One of the best habits for a trader is to continuously educate yourself. Stay updated with market news, economic reports, and geopolitical events that can affect currency movements. Regularly read books, attend webinars, and follow credible sources to improve your knowledge and skills. Continuous education ensures that you stay informed about the latest developments in the market and adapt your strategies accordingly. Developing and sticking to a trading plan. A well-defined trading plan is essential. Outline your trading goals, risk tolerance, and preferred trading strategies. Specify entry and exit points, risk management rules, and position sizing guidelines. Having a trading plan helps maintain discipline and consistency in your trading activities. It also prevents impulsive decisions based on emotions or market noise. Effective risk management. Implementing effective risk management techniques is crucial. Always use stop-loss orders to limit potential losses and never risk more than a small percentage of your trading capital on a single trade, typically 1 to 2%. This approach protects your capital and ensures that a few losing trades do not significantly impact your overall trading account. Proper risk management is the cornerstone of sustainable trading. Maintaining a trading journal. Keeping a trading journal is another valuable habit. Record all your trades, including the rationale behind each trade, entry and exit points, and outcomes. Regularly review your journal to identify patterns, strengths, and areas for improvement. A trading journal provides insights into your trading behavior and helps refine your strategies over time. Practicing patience and discipline. Patience and discipline are key traits of successful traders. Stick to your trading plan and avoid impulsive decisions driven by emotions. Wait for the right trading opportunities that align with your strategy. Patience ensures that you do not enter trades prematurely, and discipline helps you follow your plan without deviation. Staying updated with market conditions. Keep abreast of market conditions by monitoring economic indicators, central bank announcements, and political events that can influence the forex market. Use a reliable economic calendar to track important events. Staying informed about market conditions allows you to anticipate potential market movements and adjust your strategies accordingly. Diversifying your portfolio. Diversification is a fundamental risk management strategy. Avoid putting all your capital into a single currency pair. Instead, diversify your trades across different currency pairs and possibly other asset classes to spread risk. Diversification helps mitigate the impact of adverse movements in any single market. Utilizing technology and tools. Leverage technology and tools to enhance your trading. Use technical analysis tools, such as charts and indicators, to make informed trading decisions. Consider using automated trading systems or bots to execute trades based on predefined criteria. Technology can improve your trading efficiency and accuracy. Controlling emotions. Controlling your emotions is critical for consistent trading performance. Avoid letting fear, greed, or overconfidence dictate your trading decisions. Practice mindfulness or meditation to stay calm and focused. Emotional control helps maintain objectivity and prevents rash decisions that can lead to losses. Staying healthy. Maintaining a healthy lifestyle is often overlooked but essential for trading success. Regular exercise, a balanced diet, and adequate sleep contribute to mental and physical well-being. A healthy body and mind enhance your ability to make sound trading decisions and sustain long trading sessions. Regularly reviewing and adapting your strategy. Continuously evaluate the effectiveness of your trading plan and strategies. Be willing to adapt and make necessary adjustments based on your performance and changing market conditions. Regular review and adaptation ensure that your strategies remain relevant and effective. Networking with other traders. Engage with trading communities, forums, or groups to share insights, strategies, and experiences. Networking with other traders can provide valuable perspectives and improve your trading skills. Learning from others and discussing different approaches can enhance your understanding of the market. By developing and consistently practicing these habits, you can enhance your forex trading skills and increase your chances of long-term success in the market. Light discussion on various aspects of trading, from risk management to mindset and strategy. In trading, breakouts and false breakouts are critical concepts that can significantly impact a trader's strategy and success. Understanding the difference between the two and knowing how to identify and manage them can help traders make more informed decisions and avoid costly mistakes. A breakout occurs when the price of an asset moves decisively beyond a key support or resistance level, usually accompanied by increased volume. This movement signals a potential continuation of the trend in the direction of the breakout. For instance, if a stock has been trading below a resistance level of $50 and then surges above it with strong volume, it is considered a breakout. Breakouts are significant because they indicate a shift in market sentiment, often leading to substantial price movements as new trends form and traders and investors enter the market. Breakouts can provide lucrative trading opportunities. To trade breakouts effectively, traders often look for confirmation signals, such as a close above the resistance level or below the support level, along with high trading volume. This confirmation helps validate the breakout and reduces the likelihood of entering a trade based on a false signal. Additionally, traders may use other technical indicators, such as moving averages or momentum oscillators, to corroborate the breakout signal. False breakouts, on the other hand, occur when the price temporarily moves beyond a support or resistance level but then quickly reverses direction, failing to sustain the new trend. This can trap traders who entered positions based on the apparent breakout, leading to losses as the price retreats back within the previous range. False breakouts often occur due to low volume, lack of follow-through, or market manipulation, where large players push prices beyond key levels to trigger stop orders and then reverse the direction. To avoid false breakouts, traders should employ several strategies. Firstly, waiting for confirmation is crucial. Instead of entering a trade as soon as the price breaches a support or resistance level, traders should wait for the price to close beyond the level and confirm the breakout. Monitoring volume is also essential, as true breakouts are typically accompanied by a significant increase in volume, indicating genuine buying or selling interest. Low volume during a breakout can be a red flag for a potential false breakout. Using additional technical indicators can also help filter out false breakouts. For example, a trader might look for a bullish crossover in the Moving Average Convergence Divergence (MACD) indicator or an overbought signal in the Relative Strength Index (RSI) to confirm a breakout to the upside. Similarly, bearish signals can confirm a breakdown below support. Risk management is vital when trading breakouts to mitigate the impact of false breakouts. Traders should set stop-loss orders to limit potential losses if the breakout turns out to be false. Placing stop-loss orders just below the support level for long positions or just above the resistance level for short positions can help protect against adverse price movements. Additionally, position sizing should be adjusted to ensure that any single trade does not overly impact the trader's overall portfolio. In summary, breakouts and false breakouts are important concepts in trading that can influence the success of a strategy. Breakouts signal potential new trends and offer trading opportunities, while false breakouts can lead to losses if not properly identified and managed. By waiting for confirmation, monitoring volume, using additional technical indicators, and employing robust risk management practices, traders can enhance their ability to distinguish between genuine breakouts and false signals, improving their overall trading performance. The market is dynamic. Daily gold production is a crucial metric in the global supply of this precious metal, influencing its market price and availability. On average, the world produces approximately 3,000 metric tons of gold annually, translating to roughly 8.2 metric tons per day. However, this figure can vary significantly based on several factors, including mining conditions, technological advancements, regulatory changes, and economic factors. Gold production is predominantly driven by a handful of leading gold-producing countries. Nations such as China, Australia, Russia, and the United States are among the top contributors to daily gold output. These countries benefit from extensive mining infrastructure, rich geological deposits, and, in many cases, supportive regulatory environments. For instance, China, the largest producer, accounts for about 10 to 15% of global daily production, with its extensive mining operations and advanced technology playing a critical role. The daily production of gold is also influenced by the type of mining operations. Large-scale industrial mining projects, which include open-pit and underground mines, contribute the majority of daily output. These operations rely on advanced machinery and technology to extract gold efficiently and at high volumes. In contrast, artisanal and small-scale mining, ASM, which is prevalent in regions like Africa and South America, contributes a smaller portion to daily production but is significant in local economies and communities. Market conditions and gold prices also impact daily gold production. When gold prices are high, mining companies are incentivized to increase production to capitalize on the favorable market conditions. Conversely, when prices are low, some operations may scale back production or temporarily shut down, reducing daily output. Additionally, the cost of production, which includes factors such as labor, energy, and materials, can influence the volume of gold mined each day. Environmental and regulatory factors play a crucial role in daily gold production. Stricter environmental regulations and sustainable mining practices can affect the speed and volume of gold extraction. Companies are increasingly required to implement measures to minimize environmental impact, which can sometimes slow down production processes. Regulatory changes in major gold-producing countries can also lead to fluctuations in daily production levels, depending on how favorable or restrictive the new policies are. In summary, daily gold production is a dynamic and multifaceted process influenced by geographical, technological, economic, and regulatory factors. Understanding these elements provides insight into the complexities of gold supply and its impact on global markets. Gold remains dynamic over time. The daily trading volume in the Forex, foreign exchange, market is among the highest of any financial market in the world. On average, the Forex market sees a daily trading volume of over $6 trillion. This immense volume reflects the global nature of currency trading, involving a vast array of participants including banks, financial institutions, corporations, governments, and individual investors. The Forex market operates 24 hours a day, 5 days a week, across major financial centers like London, New York, Tokyo, and Sydney, contributing to its high liquidity and continuous activity. The major currency pairs, such as EUR, USD, USD, JPY, and GBP, USD, account for a significant portion of this daily volume. The high trading volume in these pairs is driven by their liquidity, tight spreads, and the substantial economic activities of the countries involved. Additionally, the Forex market's decentralized nature means that trading occurs over the counter, OTC, through a network of banks and brokers, facilitating extensive trading activity around the clock. In contrast, the daily trading volume of gold, while substantial, is significantly lower than that of the Forex market. On average, the gold market sees a daily trading volume of around $145 billion. This volume includes trading on various exchanges such as the London Bullion Market, the largest global center for over-the-counter gold trading, the COMEX in New York, the leading futures market for gold, and other regional exchanges. The gold market's trading volume is driven by various participants, including central banks, institutional investors, hedge funds, and retail investors. Gold is traded in several forms, including physical gold, bars and coins, futures contracts, options, and exchange-traded funds, ETFs. Each of these forms caters to different types of investors, from those seeking physical ownership to those looking to speculate on price movements or hedge against economic uncertainties. Gold trading is influenced by factors such as economic data releases, geopolitical events, and movements in other markets like currencies and equities. Its status as a safe haven asset means that demand can surge during periods of market turmoil or geopolitical instability, leading to higher trading volumes. Conversely, in more stable times, the volume may decrease as investors shift their focus to other assets. In summary, while the daily trading volume of gold is substantial at around $145 billion, it pales in comparison to the Forex market's staggering $6 trillion. The Forex market's vast volume reflects its global, decentralized, and highly liquid nature, whereas gold trading, despite being significant, is more specialized and influenced by specific economic and geopolitical factors. Both markets play crucial roles in the global financial system, offering unique opportunities for various types of investors. Keep your emotions in control while trading. Fear and greed can lead to irrational decisions. Several key factors affect the price of gold, influencing its appeal as an investment and its market performance. One of the primary factors is the movement of the US dollar. Since gold is typically priced in dollars, a stronger dollar makes gold more expensive for buyers using other currencies, thereby reducing demand. Conversely, a weaker dollar tends to make gold more affordable and attractive, driving up demand and, consequently, its price. Another significant factor is inflation. Gold is often considered a hedge against inflation. When inflation rates rise, the purchasing power of money declines, making gold a more appealing store of value. Investors turn to gold during periods of high inflation to preserve their wealth, leading to increased demand and higher prices. On the other hand, when inflation is low and stable, the urgency to invest in gold diminishes. Geopolitical tensions and economic uncertainty also play crucial roles in determining gold prices. During times of political instability, conflict, or economic crises, investors seek safe haven assets like gold to protect their investments from potential losses in other markets. This flight to safety typically results in a surge in gold prices. For example, escalating conflicts or significant political events can drive investors towards gold, causing a spike in its value. Additionally, interest rates set by central banks influence gold prices. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold, making it more attractive to investors. Conversely, higher interest rates increase the attractiveness of yield-bearing investments over gold, leading to a potential decrease in its price. Decisions and outlooks from central banks, particularly the Federal Reserve, are closely monitored by the market for indications of future interest rate policies. Lastly, supply and demand dynamics are fundamental to the price of gold. Gold production from mines, recycling of old gold, and central bank activities in buying or selling gold reserves all impact the available supply. On the demand side, jewelry consumption, industrial use, and investment demand are critical factors. Any significant changes in these areas can lead to fluctuations in gold prices. For instance, a decline in gold production or an increase in jewelry demand from major markets like India and China can drive prices higher. In summary, the price of gold is influenced by a complex interplay of factors including the strength of the U.S. dollar, inflation rates, geopolitical and economic uncertainties, interest rates, and supply and demand dynamics. Investors must consider all these elements when making decisions about gold investments. The market is in action. Selecting the best technical indicator for gold trading can significantly enhance a trader's ability to make informed decisions and optimize returns. One of the most effective and widely used technical indicators for gold trading is the Relative Strength Index, RSI. The RSI is a momentum oscillator that measures the speed and change of price movements, oscillating between 0 and 100. It is typically used to identify overbought or oversold conditions in the market, with readings above 70 indicating overbought conditions and readings below 30 indicating oversold conditions. The RSI is particularly useful for gold trading due to its ability to highlight potential reversal points. Gold, being a highly volatile asset, often experiences rapid price movements. By using the RSI, traders can identify when gold is potentially due for a correction after a significant price surge or drop. For example, if the RSI indicates that gold is overbought, traders might anticipate a price pullback and consider selling or taking short positions. Conversely, if the RSI shows that gold is oversold, it could be a signal to buy or take long positions in anticipation of a price rebound. Another valuable technical indicator for gold trading is the Moving Average Convergence Divergence, MACD. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. It consists of the MACD line, the signal line, and the histogram. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting it may be a good time to buy. When the MACD line crosses below the signal line, it generates a bearish signal, suggesting it may be a good time to sell. The MACD is effective in identifying trend reversals and the strength of a trend, which is crucial for trading in the volatile gold market. Additionally, Bollinger Bands can be an excellent tool for gold traders. Bollinger Bands consist of a middle band, usually a simple moving average, and two outer bands, standard deviations from the moving average. These bands expand and contract based on market volatility. When gold prices move closer to the upper band, the metal might be overbought, and when prices move closer to the lower band, it might be oversold. This helps traders to visualize price volatility and identify potential entry and exit points. Finally, combining multiple indicators can often yield the best results. For instance, using the RSI in conjunction with the MACD can provide a more comprehensive view of the market. If both indicators simultaneously signal a reversal or a continuation of a trend, it can strengthen a trader's confidence in their trading decision. Moreover, incorporating indicators like Bollinger Bands can add another layer of insight, especially in identifying volatility and potential breakout points. In conclusion, while the RSI, MACD, and Bollinger Bands each have their strengths, the best approach often involves combining these indicators to gain a more nuanced understanding of gold's price movements. This multi-indicator strategy can help traders navigate the inherent volatility of the gold market, making more informed and profitable trading decisions. Stay informed about global economic and geopolitical developments, as they can influence market movements. The gold market operates across various time zones and regions, making it a continuous and globally interconnected market. Major gold trading hubs include London, New York, Zurich, Hong Kong, and Sydney, each with their own specific trading hours that contribute to the round-the-clock nature of the market. The over-the-counter, OTC, market, where most gold trading occurs, does not have a centralized exchange or fixed trading hours, allowing for flexible trading arrangements between parties. London is one of the primary centers for gold trading, and its market hours play a significant role in global gold prices. The London Bullion Market Association, LBMA, sets the benchmark prices for gold, with trading typically occurring between 8 a.m. and 5 p.m. Greenwich Mean Time. The twice-daily, London gold fixing, at 10:30 a.m. and 3 p.m. Greenwich Mean Time establishes a standard price used by the industry. These sessions are crucial for price discovery and liquidity. New York's gold trading activities are centered around the COMEX, a division of the New York Mercantile Exchange, NYMEX. COMEX trading hours run from 8:20 a.m. to 1:30 p.m. Eastern Time, ET, providing a critical overlap with London trading hours and ensuring significant market liquidity. The COMEX is known for its futures contracts, which are influential in hedging and speculative activities related to gold. Zurich, another important gold trading hub, operates primarily through major banks and financial institutions, contributing to the global flow of gold transactions. The Swiss market generally aligns with standard European trading hours, from 9 a.m. to 5 p.m. Central European Time, CET. Zurich's prominence in gold refining and storage also underscores its strategic role in the gold market. In Asia, Hong Kong and Shanghai are key centers for gold trading. The Hong Kong market opens from 9 a.m. to 4:30 p.m. Hong Kong time, HKT, bridging the time gap between Western and other Asian markets. Meanwhile, the Shanghai Gold Exchange, SGE, operates from 9 a.m. to 3:30 p.m. China Standard Time, CST, with a break between 11:30 a.m. and 1:30 p.m. The SGE is notable for its influence on physical gold demand and pricing in China. Lastly, Sydney's gold market, though smaller, contributes to the 24-hour trading cycle. The Australian Securities Exchange, ASX, opens for gold trading from 10 a.m. to 4 p.m. Australian Eastern Standard Time, AEST. This early opening in the global cycle provides continuity after the New York market closes. In summary, the gold market is characterized by its continuous operation, with key trading hubs around the world ensuring liquidity and price discovery across different time zones. The interplay between these markets allows for a dynamic and responsive trading environment, reflecting global economic and geopolitical developments. The gold market is playing its game. Trading support and resistance levels is a core strategy in technical analysis, providing traders with critical insights into potential price movements and key decision points. These levels represent psychological barriers where prices tend to pause, reverse, or break through, influenced by the supply and demand dynamics in the market. Support levels are price points where a downtrend is expected to pause due to a concentration of buying interest. At these levels, demand for an asset is strong enough to prevent the price from falling further. Traders look for support levels to identify potential entry points for long positions, anticipating that the price will rebound from these levels. For example, if a stock repeatedly falls to $50 and then rises, $50 becomes a support level. Confirming a support level involves looking for repeated bounces off this price point and analyzing volume patterns, as higher volume at support levels can indicate stronger buying interest. Resistance levels, conversely, are price points where an uptrend is expected to pause or reverse due to a concentration of selling interest. At these levels, the supply of an asset is sufficient to prevent the price from rising further. Traders use resistance levels to identify potential entry points for short positions or to exit long positions, anticipating that the price will drop after hitting these levels. For instance, if a stock repeatedly rises to $100 and then falls, $100 becomes a resistance level. Confirming a resistance level similarly involves observing repeated price rejections and volume patterns, with higher volume at resistance levels suggesting stronger selling pressure. Trading support and resistance involves several key strategies. One common approach is range trading, where traders buy near support levels and sell near resistance levels within a well-defined price range. This strategy works best in markets that lack a clear trend and move sideways. Traders can use indicators like the Relative Strength Index, RSI, or stochastic oscillators to help identify overbought or oversold conditions within the range, enhancing the timing of their trades. Breakout trading is another popular strategy that focuses on prices breaking through established support or resistance levels. A breakout occurs when the price moves decisively above a resistance level or below a support level, often accompanied by increased volume. Traders enter positions in the direction of the breakout, expecting continued movement in that direction. For example, if a stock breaks above a resistance level of $100 with high volume, traders might buy, anticipating further gains. To minimize false breakouts, It's essential to wait for confirmation, such as a closing price above the resistance level or a significant volume spike. Pullback trading involves waiting for the price to break through a support or resistance level and then entering a trade when the price retraces to test the broken level. This strategy aims to capitalize on the price momentum after a breakout has been confirmed. For instance, if the price breaks above a resistance level and then pulls back to test this new support, traders can enter long positions, anticipating that the previous resistance will now act as support. Effective risk management is crucial when trading support and resistance levels. Traders should use stop-loss orders to limit potential losses, placing them just below support levels in long trades or just above resistance levels in short trades. This approach helps protect against significant losses if the market moves against the trade. In summary, trading support and resistance levels involves identifying key price points where the market is likely to reverse or pause and using these levels to inform trading decisions. Strategies such as range trading, breakout trading, and pullback trading can be employed to capitalize on these price movements. By combining these strategies with effective risk management and confirmation techniques, traders can enhance their ability to profit from market fluctuations. What matters isn't whether you're correct or incorrect, but rather the profit you earn when you're right and the loss you incur when you're wrong. Swing trading is a medium-term trading strategy that aims to capture price movements over several days to weeks. Unlike day trading, which involves closing all positions by the end of the trading day, swing traders hold positions for longer periods, taking advantage of market swings or price oscillations within a trend. This approach requires a balance of technical analysis, market knowledge, and timing to maximize gains while managing risks. A fundamental aspect of swing trading is identifying market trends and price patterns. Swing traders use various technical analysis tools, such as moving averages, Fibonacci retracement levels, and momentum indicators, to pinpoint potential entry and exit points. They look for signals that indicate the continuation or reversal of a trend. For instance, a swing trader might buy a stock that is bouncing off a support level or short sell a stock hitting resistance. Chart patterns like head and shoulders, flags, and double tops, bottoms are also integral to their strategy. Swing traders often combine technical analysis with fundamental analysis to increase the reliability of their trades. They might evaluate a company's earnings reports, economic data, or industry news to support their technical signals. By integrating both analytical approaches, swing traders aim to improve their chances of predicting price movements accurately. Risk management is crucial in swing trading, as positions are held for several days or weeks, exposing traders to overnight and weekend market risks. Swing traders typically use stop-loss orders to protect their capital from significant downturns. These orders automatically sell a position if it reaches a predetermined price, limiting potential losses. Position sizing is another key component, ensuring that no single trade can excessively impact the trader's portfolio. Patience and discipline are essential qualities for swing traders. Unlike scalpers or day traders who need to make quick decisions, swing traders must be willing to wait for their trade setups to materialize fully. This often involves enduring short-term market fluctuations without reacting impulsively. Staying disciplined to a trading plan and not deviating based on emotional responses is vital for success in swing trading. The flexibility of swing trading makes it suitable for individuals who cannot dedicate their entire day to monitoring the markets. It allows for a more balanced approach to trading, where decisions are made during less hectic periods. This aspect of swing trading can be particularly appealing to those with full-time jobs or other commitments. In summary, swing trading is a strategy designed to capture intermediate-term price movements within a market trend. It relies on a combination of technical and fundamental analysis to identify profitable trading opportunities. Effective risk management and a disciplined approach are essential to navigating the market's inherent volatility and achieving consistent returns. Swing trading offers a balance between the rapid pace of day trading and the long-term focus of investing, making it an attractive option for many traders. The gold game is on. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. Gold's correlation with the Japanese yen, JPY, is an interesting dynamic in financial markets, reflecting the interplay between safe haven assets and global economic factors. Both gold and the yen are traditionally considered safe haven assets, meaning they are sought after during times of economic uncertainty or geopolitical instability. This shared status often leads to a notable correlation between the two, particularly in periods of market stress. One key aspect of the gold-yen correlation is their inverse relationship with the US dollar. When the dollar weakens, both gold and the yen typically strengthen. This happens because a weaker dollar makes gold cheaper for holders of other currencies, increasing demand. Similarly, the yen often appreciates as investors seek stability away from the dollar. Thus, during periods of dollar weakness, both gold and the yen tend to move in the same direction, reinforcing their correlation. The correlation is also influenced by global economic conditions. In times of global economic uncertainty, such as financial crises, political turmoil, or significant market volatility, investors flock to safe haven assets. During these times, both gold and the yen see increased demand. For instance, during the global financial crisis of 2008 and the market turmoil caused by the COVID-19 pandemic, both gold and the yen appreciated significantly as investors sought refuge from the instability in other markets. Monetary policy in Japan also plays a role in this correlation. The Bank of Japan's BOJ policies, particularly its stance on interest rates and quantitative easing, can affect the yen's value. When the BOJ implements ultra-loose monetary policies, it can lead to yen depreciation. However, if these policies are seen as stabilizing measures, the yen might still attract safe haven flows, maintaining its correlation with gold. Conversely, tightening policies can strengthen the yen, aligning its movement with gold if global uncertainties persist. Additionally, inflation expectations and real interest rates are crucial factors. Gold is often used as a hedge against inflation, while the yen, being a low-yielding currency, can be sensitive to changes in real interest rates. When real interest rates are low or negative, both gold and the yen become more attractive. This shared sensitivity to interest rate changes can lead to periods where their prices move in tandem. In summary, the correlation between gold and the Japanese yen is primarily driven by their roles as safe haven assets, their inverse relationship with the US dollar, and their sensitivity to global economic conditions and monetary policies. During times of market stress and economic uncertainty, both assets typically see increased demand, reinforcing their correlation. Understanding this relationship helps investors make informed decisions in times of economic volatility and uncertainty. Gold is working. Gold's high volatility offers numerous opportunities for traders to profit, provided they adopt the right strategies and risk management techniques. One effective approach is to engage in short-term trading strategies, such as day trading or swing trading, which allow traders to capitalize on the frequent price fluctuations within a day or over several days. By closely monitoring gold's price movements and employing technical analysis tools like moving averages, Bollinger Bands, and the Relative Strength Index, RSI, traders can identify potential entry and exit points. These tools help in predicting trend reversals or continuations, thus facilitating timely trades. Another method to leverage gold's volatility is through options trading. Options give traders the right, but not the obligation, to buy or sell gold at a predetermined price within a specified time frame. This can be particularly advantageous in volatile markets, as it allows traders to benefit from price swings without the need to hold the physical asset. Strategies such as straddles and strangles, which involve buying both call and put options, can be effective in capturing gains regardless of the direction in which gold prices move. The key is to anticipate significant price movements and structure option trades that can profit from such volatility. Additionally, using leveraged products like gold futures and leveraged ETFs, exchange-traded funds, can magnify potential returns from gold's price movements. These financial instruments allow traders to gain larger exposure to gold prices without needing to invest a large amount of capital upfront. However, it's crucial to manage the inherent risks associated with leverage, as it can also amplify losses. Traders should implement strict risk management practices, such as setting stop-loss orders and maintaining appropriate position sizes, to protect their capital. Furthermore, keeping abreast of global economic events and geopolitical developments is vital. Gold prices are highly sensitive to macroeconomic indicators, central bank policies, inflation rates, and geopolitical tensions. By staying informed about these factors, traders can anticipate periods of high volatility and adjust their trading strategies accordingly. For instance, during times of economic uncertainty or political unrest, gold often sees increased demand as a safe haven asset, leading to significant price movements. In summary, traders can take advantage of gold's high volatility by employing short-term trading strategies, using options and leveraged products, and staying informed about global economic and geopolitical developments. Effective risk management is essential in all these approaches to safeguard against potential losses and to ensure sustainable trading success. The gold market is going on. An interest rate cut typically has a significant impact on the price of gold, often leading to an increase in its value. This relationship stems from several interconnected economic factors that influence investor behavior and market dynamics. When central banks, such as the Federal Reserve, cut interest rates, the return on interest-bearing assets like bonds and savings accounts decreases. This reduction in yields makes these investments less attractive compared to non-yielding assets like gold. Consequently, investors often seek alternatives to preserve or grow their wealth, and gold becomes a more appealing option due to its historical role as a store of value. The increased demand for gold as an investment drives its price higher. Lower interest rates also typically lead to a depreciation of the national currency, in this case, the US dollar. A weaker dollar makes gold, which is priced in dollars, less expensive for buyers using other currencies. This increased affordability boosts international demand for gold, further contributing to a rise in its price. The inverse relationship between the dollar's strength and gold's price is a well-established market principle, where a decline in the dollar enhances gold's attractiveness as an investment. Additionally, an interest rate cut can signal concerns about economic growth and stability. During periods of economic uncertainty or downturns, central banks often reduce rates to stimulate the economy by encouraging borrowing and spending. In such scenarios, gold is perceived as a safe haven asset, providing a hedge against economic instability and inflation. As investors flock to gold to safeguard their investments, the heightened demand drives up its price. Moreover, lower interest rates can lead to higher inflation expectations. Gold is traditionally viewed as a hedge against inflation because its value tends to rise when the purchasing power of money declines. As inflation erodes the value of fiat currencies, gold maintains its intrinsic value, making it a preferred asset during inflationary periods. Therefore, expectations of rising inflation following an interest rate cut can increase investor demand for gold, pushing its price higher. In summary, an interest rate cut typically results in higher gold prices due to several factors: reduced attractiveness of interest-bearing assets, a weaker dollar, heightened demand for safe haven investments during economic uncertainty, and increased inflation expectations. These dynamics collectively make gold a more attractive investment, driving up its market value.